Assalamualaikum and salam sejahtera everyone. Before we proceed with the lecture today, let us recap what we have learned in our previous class. If you still remember, we have discussed in detail the statement of financial position, or also known as balance sheet. And now, we are going to learn about the other important financial statements, which is the statement of financial performance. For your information, both financial statements play distinct roles in providing insights into a company's financial performance and position. But they focus on different aspects of a business's operations. Let us start. The statement of financial performance or income statement, often referred to as the profit and loss statement, is like a financial snapshot that tells the story of a company's financial performance over a specific period. It serves as a dynamic window into the heart of a business operations, shedding light on its revenue, expenses, and ultimately its profitability. In essence, the income statement unveils the monetary pulse of an organization, the inflow and outflow of financial resources that drive its activities and determine its success. Now, class, moving on to the next slide on the format of the statement of financial performance. Okay, students, this is the standard format of an income statement where at the top of the income statement you will find the company's name and a title like income statement or statement of financial performance. It also mentions the period covered by the statement, which could be a month, a quarter, or a year, but it's normally being presented in a year. Okay, this is where the story about money begins. It is the total amount of money the company made by selling its products or services. This is usually the first line, and it is often labeled as revenue or sales. Next, the cost of goods sold, COGS. Think of this as the cost of making or buying the things the company sells. If you are running a coffee shop, COGS would be the cost of coffee, sugar, cups, milk, and so on. This number is subtracted from revenue to find out how much money is left after covering the costs directly linked to making the goods. Now, the gross profit. This is like a prize you win in a game show. Subtracting COGS from revenue gives you the gross profit. It shows how much money the company made just from selling its main products or services. Alright, student, let us now try to understand the second part of the income statement, which is the operating expenses. The operating expenses are the costs of running the company day to day. Imagine it is like the bills you pay for your cell phone, internet, and other necessities you need to live comfortably. Operating expenses include things like salaries, rent, utilities, marketing, advertising, research and development, and more. On the other hand, the depreciation is a non-cash expense. But wait, what is depreciation? Imagine you buy a shiny new laptop. As time goes by, its value decreases. This decrease in value over time is known as depreciation. In the context of business, it applies to assets like buildings, machinery, and vehicle. When an asset loses value due to wear and tear or obsolescence, the company recognizes this as an expense on the income statement. This expense is spread out over the useful life of the asset. Why? Because the asset helps the company generate revenue over several years. It is fair to account for its costs over those years too. For example, if a company buys a machine for $10,000, that's expected to last 5 years. Each year, it might record $2,000. 10,000 divided by 5 as depreciation expense in the income statement. These reduce the company's report profit, which reflects the true cost of using the machine to generate revenue. One thing to understand is the depreciation expense is recognized over time in the income statement, while accumulated depreciation builds up over time in the balance sheet. Okay, now we are getting closer to the heart of the company's financial performance, which we will discuss on the operating profit or earnings before interest and tax, EBIT, or also known as its operating income. The operating profit can be derived by subtracting the total operating expenses from gross profit, and you will get operating income. It's like finding out how much money the company made after considering all the regular expenses. For your information, EBIT represents a company's earnings before any interest and taxes are considered. Okay, the next component in the interest expenses, and the interest expenses are what the company pays on loans or borrowings it has taken. Subtracting this expense from EBIT accounts for the cost of borrowed money. It is like recognizing the money that needs to be paid out for using borrowed funds. After subtracting interest expenses, you are left with EBT. This is the company's earnings before taxes are considered. It is like saying, here's how much money the company has earned before any tax are applied. Now we deduct taxes from EBT. Taxes are what the company must pay to the government on its earnings. This step calculates the company's net profit before considering dividends or retaining earnings. The next profit after tax, EAT, is what remains after taxes. Net profit after tax is the money the company has earned after paying its due to both interest and tax. It's likely the final amount of earnings the company has in its pocket. Now, we are considering what happens to company's earnings after paying its obligations. Dividends are payments made to the shareholders, usually a portion of the company's profit. Subtracting dividends from net profit after tax shows the portion of earnings distributed to shareholders, and lastly, what left after dividend is called retained earnings. It is like the money the company decides to keep for its own use instead of distributing it all to the shareholders. This amount is often reinvested in the business for growth, paying off debt, or saving for future ventures. Okay, class, that's all for now. You can ask me any question if you have any inquiries. As a preview, we will learn about the sources and uses of funds in our next lecture. Thank you everyone for listening.